Hello, everyone. Welcome to the show. It's not even a show, but I like to think of it as a show. It's our weekly robot trading show where we talk about how to make trading systems, how to make robots better, how to trade robots, new robots I'm coming out with, or anything that's going on in my mind. It seems to me, as I'm talking to you, that I sound a bit nasally. I don't know what it is. Allergies? Allergies are a pain in the neck. I'm really tired of allergies. Why can't we rid the world of allergies? But anyway, I'm going to minimize the question screen and we're going to get started. We're going to talk today about why I'm so ignorant, or at least I was, and how we can improve upon that, or taking an idea that maybe you've had in the past and how taking a look back at it with fresh eyes, you might be able to come up with something that's kind of good. So let's talk about it. First and foremost, uh, I did some interviews. Last time I'm going to talk about it. I'll talk about something else next week, but I did make a list of every interview that I've ever done, and it's on my website on my interviews page. So if you ever want a bunch of interviews, check it out. All right, let's talk about common sense. Now, ignorant, first of all, I say ignorant common sense there doesn't mean that stupid. Ignorant does not mean stupid. In fact, ignorant in a lot of cases is not even a bad word. You can be ignorant, you just didn't know. You're ignorant about how to do brain surgery. Doesn't mean you're stupid. Just means you don't know yet. So even though I'm criticizing myself and how I created my first robot portfolio, it doesn't necessarily mean I'm stupid. It doesn't mean you have to write into my little box and say that I'm stupid, right? That would hurt my feelings. It just means ignorant, 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 ignorant. Anyway, let's, yesterday I talked about, let's get out to it. Why am I pronouncing that word? Let's get to what we're talking about today. Now, in the weekly newsletter blog post, we talked about my original portfolio of robots. And this goes back to all the way to 2012. It goes all the way back. Now, that's not forever, but we're going on, what, 6 years now? So that was a long time ago that I got introduced and then obsessed with portfolios of robots or just trading robots in general. And I talked about that yesterday and how it came to be. And then I talked about how I looked back upon it and how there are some ways to possibly make it better. But let's get into a little bit deeper before I talk about that on how I came up with this particular trading system. Because if you're out there and you're new to trading, and I've gotten some emails lately from people who are brand new to trading, and they're like, well, what do I do? Or what robot should I create? Or what robot should I trade of yours? All bunch of questions for new people. There are a couple ways you can go about making your own system. You don't need to get one of mine. You can make one of yours. And there are two real, again, it's very general, but there are two ways that are good ways to make up your own trading system. And they're both based on research, of course, because I'm not a big fan of just flying by the seat of your pants. I know it can be done. I'm just not a fan of it. I know that you can probably trade it extremely profitably by looking at a chart, just winging it and taking it off with 3 pips one day and 35 pips the next day and 300 pips the next day. I'm sure it can be done. All right. I'm just saying. I'm not a fan of it. I am a fan of tons and tons of research. So if we're going to do tons and tons of research, there are two ways to do it. One is to just crunch numbers, data mining, they call it. I'm not even really a big fan of this because what you can do is go deep into the numbers and set up your testing software so that you look for certain anomalies. And the one I used yesterday was very persnickety. It's only trading on Tuesdays and only trading between this particular time and only if the S&P does this and that. You can start putting layers upon layers upon layers, stacks upon stacks on stacks of different trading rules to get to a point where it seems like something's repeating. The problem for me is that if you keep layering filter upon filter upon filter, keep narrowing it down, what you're doing is just basically getting into a luck situation. Stuff that doesn't happen very often, or even worse, may not ever happen again, right? Or so rarely that you can't make money off of it. By going layers upon layers and just crunching numbers, you get into a situation where it doesn't repeat. It was just a bunch of things like somebody walking outside in a red hat when it's raining. Haha, every time that happens, I make $400. I mean, is it really causation? Does one really cause the other? I mean, it's happened, right? I've seen it happen 3 different times, right? That sort of thing. Or it's something that all lined up and just isn't going to happen again in the future. So I'm not a big fan of that. Although if you keep the rules general, I think it can be done. So if you're just looking at circumstances, it can be done, but be very careful. Be very careful that your rule isn't too persnickety or too specific. Make sure it can happen again in the future. But my favorite way, and again, one way isn't better than another, is based on universal truths or common sense. That's the way I like to build stuff. Why? Because if it's a universal truth, it will probably last forever. That's what I do in my tennis teaching also. I take something that works on the tennis court, but isn't just lucky that this particular student on this particular day, on this particular surface, this stroke will work against one particular opponent. I don't do that. I look at a technique or a form that exists in every sport. Usually what I teach on the tennis court is also how you might, for example, serve will also work in volleyball and will also work in basketball and will also work in football and will also work in baseball. Like I like universal truths. If you do this sort of technique, it will make you better at multiple things. So it's universally true. We've talked about this before, but I want to pound this point home because it's so important. Same thing in trading. I like things that are probably going to be true forever. We can't know, but any sort of common sense and any sort of deep thinking would probably indicate to us that this is going to be true forever. So even though I was ignorant, totally ignorant, and even more ignorant than you even think as we get into further slides, this portfolio I made in 2012 was based on what I thought was universal truths. Right? And what were those truths? Well, I had done a Bosslater course. Now, the Bosslater course, if you're interested, was a system created by Rob Booker himself that I studied and learned from him. And then we expanded on it, did a course for about a year. And then I took some ideas from Bosslater and went out and made a few tweaks to it, which is the best thing to do. Take somebody's great idea and try to make it your own. Right? Rob says that all the time, and so do I. So I had been studying fair value for quite some time. Excuse me, had an itch. And we had been studying fair value. And fair value to me, remember, I'm a value investor. The first books I ever read was value investing. So fair value means a lot to me. Warren Buffett was the first books. Buy something on sale, you buy it back to fair value, right? Those are the first books I ever read. It's the first trades I ever took. So understand that trading fair value is in my trading DNA. So I took the universal truths when making these original robots, and I said price always moves back to fair value. You understand this is 100% true. If you use it on a chart and you say a moving average or moving averages or a pivot point, right? These price will always move back to fair value. Now, of course, you're thinking if it's a pivot point, it may never get back. Yes, that's true, but 99% of the time it will reach all pivots. For example, do you know, this might blow your mind, that every weekly pivot point, now taking long trades only, every weekly pivot point, long trades only, has been hit on the Dow Jones since 1929. Does that blow your mind? Every single one. I've done the research, people. Isn't that interesting? Now, there are some short pivots that haven't been hit, right? But every long pivot point, and I can do that research again. I've done it twice, but I'll do it again if you don't believe me. So just email me and say, I don't believe you, to which I'll say, okay, and I'll go research it again. But what I'm specifically talking about is a moving average. If you decide that a moving average of some sort is your fair value, guess what? Price will always touch it. It may not touch it when you want. It may not touch it so that you can have profit, but price will converge on a moving average 100% of the time. It's not arguable because it's based on math. The average is based on actual price, so they will meet. So if price gets away from fair value, and that fair value is a moving average or something numerical, they will meet. Right? So that's a pretty good universal truth since it's 100% true. Now, I didn't just stop there, though. I said, well, once price does move back to fair value, it doesn't just stop there forever. It has to go somewhere. And this, again, is 100% true. It's not going to stay exactly on a moving average or any sort of indicator you have forever. It's going to go somewhere. So I started my portfolio with two 100% true statements. That's pretty cool, right? Ah, I'm using my brain. Now, I went further and said every good, and I really meant great, right? Every fantastic, wild, wonderful trend that has ever happened in any financial instrument, any stock that has ever exploded, long or short, any futures contract, any Forex instrument, anything that's had this huge move has started from fair value because at some point it went back to equilibrium. So it's not really arguable. Now you could say that, well, if you only look at it through the perspective of starting from fair value, there might be a huge portion of that trend that was missed. So you could argue and say, well, the trend started earlier than when it started from fair value, in which I'd say, I guess. But that's not really that great of an argument because if you just use fair value as an argument, a starting point, everything breaks out from there. So yeah, it's mostly true that maybe you missed some of it, but really it's 100% true that every huge trend has started from fair value, right? Just go look at your charts, right? Everything starts from somewhere. So 100% true, 100% true, 99.9% true is where I started. And so I said, well, if these three are true, I want to get involved and I want to try to take a trade on every single breakout from fair value because you never know. You never know. You never know when this might be the big one. It's the big one, Elizabeth. You never know when this might be the move that makes you $1 trillion. So that's what it was based on. All that makes sense, right? You can't really argue me out of that. Maybe you could make it better because you're not ignorant like I am. But those are pretty good universal truths. So this seems like a really good robot. So what's the problem? Well, here comes the ignorant part. Don't make fun of me. All of that makes sense. Hopefully you agree. But the putting together of the portfolio, that was extraordinarily ignorant. How was it ignorant, you ask? Well, thank you for asking. I didn't know what profit targets to use. I mean, what do you use? Yes, everything breaks out from fair value. That's a given. But how far? That's tough. Let's say we're talking about Forex. All right. Let's say we're going to trade every financial instrument that say it's going to go 50 pips in one direction or the other. Okay, 50 is my profit target. Well, guess what? It depends on your stop then. Well, what's your stop loss? Well, I have to give it room because it's going to flutter around fair value while the traders decide which way it's going to go. So let's put a 100 pip stop. Well, in the long term, 50 pips of profit may not be enough. 50 pips, 50 pips, 100 pips stop out. 50 pips, 50 pips, 100 pips stop out. I'm getting nowhere. So maybe 50 isn't enough. Well, I'll say 200. Okay, it's 200 pip profit target, 100 pip stop. Haha, 2 to 1, the magic risk to reward ratio that everybody desires. Well, what if it doesn't move 200 pips? What if it moves 180? All right, so you don't get that profit target, and you get stopped out, right? So it is not an easy question. It took a long time and a lot of study to figure out what profit targets to use, and I didn't know. It took a lot of testing, and it was hard testing. This was not easy. Furthermore, I didn't know what trade sizes to use. It seems common sense to me now that when you put together a portfolio, everything should be weighted equally. I didn't know that back then, though. I thought, well, this one's fun. Let's put that at 2 lots. And this one's not as fun, so I'll put it at 1 lot. Well, how do you know? I mean, how do I know? How do you know what's in the future if 2 lots is too much? Well, that will make your losses too big. What if you trade one bigger than the other, and that's the one that goes through a losing streak? So now instead of being a little bit of profit, you have no profit. I didn't know that back then. I learned through time that if you want to trade a bunch of stuff, you should use the same trade sizes. Okay. Well, that's not necessarily true. I mean, it's mostly true, right? But here's the thing. You need the drawdowns to be the same. Ha ha ha. That's the real secret. And what happens is when you have a breakout portfolio like this, keeping all the trade sizes the same keeps almost all of the drawdowns the same. Now, if you trade a different type of robot and you have one, for example, like the Euro Aussie is extremely active and is a robot that I trade. Well, I don't trade that with as much trade size as a different one, let's say the dollar yen, because the Euro Aussie trades so much more often that it has like 4 times the drawdown level for the same amount of trade size. You get it? 1 lot on dollar yen says that makes $1,000 of drawdown. 1 lot on Euro Aussie makes like 4,000. Why? Because it trades so much more. Okay, that's just an example. What you have to do is make sure that everything in your portfolio has about the same amount of drawdown. Then you can proceed. So that might mean exactly the same trade sizes. In fact, that is a great place to start. But if you want to get tricky, I learned that you have to keep the drawdowns the same. Okay, I learned that. How did I learn that? Trial and error and watching robots every day for almost 6 years. Okay, but at the time I didn't know anything, so I was just going willy nilly, baby. I was just throwing trade sizes around like they were candy. Ah. And then what do you trade? What do I trade? And how many? 1, 2, 10, 50, 100? Like, what do you trade? Well, this is embarrassing, and please don't make fun of me. But I just tried to find a bunch of different letters. I thought if I have Aussie in one and Japanese yen in the other and British pound and US dollar and euro, if I just had a bunch of different letters, then clearly they won't all take the same trades and they won't all go in the same direction and I'll be diversified. That's literally how I thought of it. That's and that's embarrassing. And how did I come with 8? Well, I ended up with 8. How did I come up with 8? I have no idea. Why? I guess 8 was enough. I'll tell you why. It looks neat on my screen. Here's that portfolio. Oh, you need to move that down. Oh no, that's embarrassing. Move. Okay, there. Here you go. Look at how neat that looks on a TradeStation screen. I'm scared that I thought that this just looked good, and so I settled on 8. I don't want to say that about myself, but it's possible. Okay. So anyway, back to the program. But I think ultimately I thought, well, that's enough different letters. I think that's enough. I think I just settled on that. But I have no idea looking back why I chose 8. I honestly have no idea. So that's what I did. I was throwing profit targets around and trade sizes around. And I mean, you can see all the problems that you can have when creating a portfolio. So learn from me. Make your trade sizes the same, or at least make your drawdowns the same, and use the instruments that make sense. And here's my last tip. Use as few of them as possible. I love minimizing and focusing. Anyway, well, here's the spreadsheet, right? Here's how the numbers came out. Now, keep in mind, I have not touched these robots since I sent them free in 2012. Well, that's not true. I did make the trade sizes the same, and that was shortly after 2012. So this has been running. As far as the inputs, they have not been touched. So we have a nice walk forward test. And the only change I made is I made the trade sizes the same. And that's been for literally years, right? Don't vary the trade sizes based on whims. I just wanted to say that one more time. All right, check it out. So here they are. 1, 2, 3, 4, 5, 6, 7, 8. There they are. Look at all the different letters. See that? Okay, anyway. Here are the monthly results. I've been tracking these all the way back since 2012, right? See that? May 2012. Did I trade this live? Yes, I did for a while. And here are the years, right? And this is based on a hypothetical $10,000 account. Well, that's a nice return, right? That's decent. That's 22%. That's 26%. Oh, that's a little bit of a lean year. Oops. 2015, nothing worked. Check this out. I highlighted it in yellow. Look at this stretch of trading. Look at that. Losing month, losing month, losing month, losing month, losing month. Wow. From June to October, that's a lot of losing. And then you had a winner before that, but then a big loser before that, and then a small winner and a big loser before that. And then, right, that was a rough stretch, which all of that added up to negative $3,700, which is a 37% drawdown on a $10,000 account. It probably in real time was even higher than that, right? Because these are month end numbers. Whoo, that's a rough, right? That is some of 2004 and 2015 in there. But as it turned out, 2014 from a calendar year was profitable and 2015 was not. But look at what happened. What goes down must go up. It came back with the best year in the past 6 years right after that. And then 2017 has been really great, right? Or mostly great, okay? So there you go. That's how the numbers came out, right? The rest is pretty good, all right? But let me go on a very brief rant, okay? Going back to that spreadsheet, look at that. If you look at all 6 together, we average $133 per month on a hypothetical $10,000 account. That's 15. That's an average of over 15% a year, right? About 16% a year. Pretty good, right? If you had a $500,000 account, you'd be making decent money, right? In a 6-year perspective, these numbers look just fine to me. However, it just absolutely is fascinating to me that no one right? No one is going to email me for this portfolio. Zero. You know why? Because of that. Nobody. The online traders are so picky. I don't want to say arrogant. I don't want to say haughty. I don't want to say bad words, but nobody is interested in something that loses for a year. And I find that so funny. If I talk about robots or whatever, every single person that would emails me, and I get 99% positive emails, right? Because if you send me a negative email, I'll just delete it and never speak to you again, right? I don't mean you can ask me questions and be as respectful as possible. I love discussions, and I'd love you to tell me that something can be improved positively, right? But that internet trolling stuff, I mean, that's for the birds, man. I mean, you suck. I mean, come on. Anyway, intelligent discussions, I love anything intelligent. Okay. But I find it so funny that no one, right? Anyone who sees a losing year would say, that's garbage, that's stupid, right? There's just no doubt about it. Okay, so in the online world or in the trading world, that's garbage. This system is garbage. In the real world, the majority of traders that live currently on this planet, this would be awesome. This would be no big deal at all. If I worked for a mutual fund and I could go out and sell this, I would be a multi-millionaire. I could sell this to I could sell this to anyone. I could go to anyone and sell these results, right? This kills index funds. It kills mutual funds. It destroys people. This losing year is nothing in the real world, right? I've heard people talk about their investments. Well, I've had the same mutual fund for 10, 15, 20, 25 years, right? Yeah, some losing years, but mostly it's been good, doing good. If you talk to somebody who traded mutual funds or just invests for the long term, and these are their results, all of their friends would be signing up for it. Isn't that amazing? And yet, online traders would throw a bunch of monkey feces at this, right? Isn't that funny? Isn't that amazing? Isn't that crazy? What is wrong with us? Because guess what? I said us, I would throw this out too, right? I'm just like you, right? Or maybe you're better than me, right? But I wouldn't trade this because of that too. So what's wrong with me? I just find that so funny. Anyway, let's break this down though, right? Why did I pick what I pick? Well, I just told you I didn't have any good reason. I just made up 8 names, right? I just made up 8 names. Well, take a look, right? What should work for a portfolio like this? Here's a trade. This is a typical recent trade. This is July 2017, right? Fair value, hovers around, makes a little move up. Oh, look, it's decided to go long. Okay, so I took a long trade. And look at this ride, blah, 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 up and down roller coaster. But you keep the stops wide and you get a nice monster win, right? That's what the portfolio looks like, okay? That's typical, right? So you need something that trends. Something that just does this and comes back, and that's all it ever does, guess what? That's never going to work, ever. So what should work for a portfolio like this? We need trenders. We need breakouts from fair value. So shouldn't I stop just mixing letters? Shouldn't I pick something that trends like crazy, not something that putters back and forth? This needs big winners. So why don't I pick something that wins, right? So what here is a trender, and what should I eliminate? Aussie yen trend? Yes, like crazy. Pound Swiss? Yeah, I'd say better than average, right? Tell me if this is not your experience. Anything with JPY on it is a trend, right? That's good. There's a pound dollar trend? You bet your bottom dollar. Dollar Swiss? No, no. You can either know this from experience if you're a trader, look at a chart and just look at it, or go look up your average true ranges. I did. Guess what the lowest one was? Dollar Swiss. Oh, New Zealand dollar, is that trend? No. Look at the charts. Look up your ATR numbers. No. Pound yen? Yes. Euro dollar? Yes. Right. So of these 8, this one doesn't belong. One of these things is not like the others. Well, 2 of these things. These are terrible. Why? Who would pick these for a trending system? Dumb. So what happens if you did something as simple as don't be an ignorant fool and take those out? Well, if I hit that, okay, now this is a portfolio, has 6, different letters on it that only pick stuff that trends. Well, let's take a look. Oh, per month goes up. Per year goes up. Still has a losing year, but you see how much it dropped? It dropped almost down to nothing. Oh, look, the winners went up, right? Everything goes up. Oh, take a look at the drawdown. Wow, it's not so bad anymore. Here's your worst. That's your worst little run. Only 1,400. So instead of over 3,700, it drops down to 1,400. And if I add a few more months, 1,500. But that's the worst it gets. So you're looking at 1,400 or 1,500, less than half, significantly less than half. Per month goes up and per year goes up, right? All because I didn't pick something stupid, right? So the trending ones are in order, right? All of those. Euro dollar, yes, that's a trender, right? It's less so, but yes, right? Pound Swiss, you can maybe eliminate that, but average true range numbers are good, and we've seen some big moves, right? But clearly not those two, right? And then there we go. There's the summary. When you take those two out, everything goes up, right? We get more returns and way less drawdown just by getting rid of ones that shouldn't have been chosen anyway. I mean, what was I thinking? Oh, it's embarrassing. And here's the bottom line before I get to your questions. Horses for courses, right? They say this about golf. If you have someone who can drive the ball a long way, then a short course, they're going to eat it up. If you have someone who has big rough, then accuracy matters, right? Same thing for tennis players. Great players play different on great surfaces. Rafael Nadal on clay is virtually unbeatable. Rafael Nadal on other surfaces, beatable, right? You need to match your strategy with stuff that will work for that strategy, right? Another example, successful stock traders go about screening process. A successful stock trader, at least the ones that I research, don't just pick any stock. They pick stocks that work for what they're doing. In fact, picking the stocks for big-time stock traders is more important than their system. Have you ever looked up someone who's wildly successful, at least allegedly, I assume they are, and then finally get to their trading system? It's like a beginner. It's like a second grade trading system. Like it's almost like they don't know what they're doing. But they pick the right stock, so it doesn't even matter. You get it? If you trade the right stock, you can I'm just buy it. I don't even have a sell. I don't even have a profit target. It looks like it's going down, right? And you can make huge money without even a trading system. Horses for courses, right? Thus, in trading a trending system, you need instruments that trend, right? So would this system be even better if I used common sense and added even more trending? Well, I've already looked at Euro Aussie, and guess what? Does Euro Aussie trend? Yes. How does Euro Aussie do in the system, do you think? Just out of guess. Guess what? It works, right? And I didn't even test it. I just put some standard generic inputs on it, and it works, right? So maybe I might add even more trending ones, right? And it would work even better. All right, let's take a look and see if we have any questions before we get out of here. Let's see here. Let's roll back. All right, here we go. A couple questions coming in. Daniel says, ignorant common sense. Can I elaborate? Well, it was common sense, but I didn't know if it would work, number one. But common sense should work, right, Daniel, forever? But I said ignorant common sense because I didn't know how to put it together. The very next slide. Hopefully that makes sense to you now. The common sense actually turned out to be very common sense indeed, very useful. But the putting together of the portfolio, that was the ignorant part. Elima, thank you, Elima. And Elima says she likes how I do so much research. Well, I'd love to take credit for that, Elima, but I love researching. It's my favorite. I love it, love it, love it so much. Daniel says, when you discovered your profit to risk ratio, did it apply to all venues? Daniel, I'm not sure. When I discovered my profit to risk ratio, did it apply to, oh, you mean for all of the portfolio? Yes. For this one, I did have a favorable risk to reward. Yes, it was 2-to-1 or 1.5 to 1. Yes, all of these had favorable, meaning more, you get more wins bigger than the losses. Okay, so yes, they all traded that way. And Mel says greed. Yes. All right. All right, everybody. I thought that was very valuable. Putting together your own system or just thinking through your own system or just thinking about trading in general, it's fascinating for me to go back and look at mistakes that I made and things that I've learned, and hopefully that can apply to your life and your system and your robot trading or whatever you're trading in general. Hopefully that's helpful. All right, everyone, that's all for this week. I'll be back next week with more stuff. Don't forget the Friday post coming out. I've got another one coming up tomorrow. We've got the Heron still going. No trades recently, so I mean, or maybe one. It's been kind of quiet. We'll be talking more about futures and stocks and maybe this portfolio also. And we're over 800. Yay, over 800 on YouTube now, so that's great. All right, everybody. I'll see you next time. Bye for now.